Welcome back to the Hidden Money Podcast. Today we are doing our second episode of our real estate series. This one's exciting to me, uber exciting to me, because we have seen so much success in our client base, both in them making a lot of money and what we love the most, not paying much in taxes or saving a ton in taxes. It's exciting. Vacation rentals, it's a big thing that happened and occurred. It tripled in the amount of vacation homes out there during COVID. If you happen to have a vacation rental during the COVID shutdowns, boy, you made money hand over foot, whether or not your property was worth it. People got onto that. They bought a lot more. So it's a much more competitive market, but we still see clients going and buying properties now, buying properties 6 months ago with these higher interest rates and making positive cash flow. And there's always the tax benefit. And now that we had the One Big Beautiful Bill Act pass on July 4th, bonus depreciation 100% is back, and it makes it, and I'm not joking, there are ways. We've seen this happen more times than we've seen a lot of times where people are able to save more in taxes than their down payment was on the vacation rental that they bought. They bought an appreciating asset that's growing their net worth and their financial freedom. And in reality, the IRS gave them the down payment for it. I love vacation rentals for that reason.
Yes, and that's a very specific case to where you need to be kind of in the higher tax bracket,
Or a purchase price allocation.
or we could do a purchase price allocation, which we'll get into as well, of kind of what that even means. But we have seen it, especially with 100% bonus depreciation and just simplicity of math, the tax impact it can have if you structure it right. There's so many rules to vacation rentals that you cannot just go buy a short-term rental and then, hey, tell your CPA, hey, I bought this. There's so much in between that we have to kind of button up.
Not to mention, there's a lot of misinformation out there on some well-known podcasts. So just be very careful.
And so when you're kind of vetting if this strategy is right for you, just a simple formula. You take the purchase price of the house you're looking to buy, the vacation rental. I typically do 10% of that. You can do even higher depending on, the type of property and your income level. But let's say you buy $1 million property. I would expect 10% of that to be your tax savings, $100,000.
Assuming you're in the top two tax brackets,
yes,
so 35 or 36.
If you're in the 20s tax bracket, you can still buy a short-term rental and do the strategy. It's just not going to be as impactful as the person who's making $1 million and buys $1 million property.
Although there are caveats. We had a client just 3 weeks ago in the 24% tax bracket who got back more than 10%, about 14% in taxes over 2 years. Because he got all of his taxes refunded this year and he'll get them all refunded next year. And when all was said and done, he actually got more from the IRS than his down payment was on this beautiful property in Tampa, Florida.
Yeah. And just from the onset, this may sound like it's too good to be true. And most things in life are that way. If we're up here and we're trying to say, hey, there's tax benefits where the government is going to pay you to get into vacation rentals, it sounds a little weird.
It does.
It does. And so I know what we're saying is crazy, but it is true. And to even back that up, we're getting audited. Some of our clients are getting audited because of this. Now, don't be scared of audits. We're not scared of them. We show our work. Everything we do is above board. But whenever we're going through this audit, I'm passing the audits. And it's not even close. It's not even a point of contention in the audit that they're really pushing on this strategy.
Qualifier. When we have helped the client file and they used our strategies that we walked them through and filed those tax returns, we're passing the audits. Sometimes we get people that used someone else and bought a vacation rental and did some funky things they shouldn't have done. And we're not passing them with flying colors, but we're still helping them pass in a much better result than they would have.
Yeah, and one example of that is, let's get into, you mentioned depreciation. The way to get depreciation off this short-term rental property and accelerate a large part of the property is doing what's called cost segregation. We have a cost segregation engineer on our team. He's been doing this for his career. And he's on our team. We've been working with him for 7 years, and he's just a good dude. He gets a great product, a great result. Our costs are lower, but he defends his cost seg. If you're audited, he's going to come in and jump in and defend his cost segregation analysis. We are going through an audit on somebody who did a DIY cost seg. That is to your point of what you just said. They did the cost seg online by themselves with this group, and the IRS is pushing back on it saying, I don't agree with this, back it up, back it up.
And on that do-it-yourself cost seg website, it says audit defense is included, which is hogwash. They will defend their formulas, but the way that stuff works is you basically have to become an engineer or real estate professional and give it the inputs, the right kind of inputs. They're not going to defend your assumptions that you had to make to create that do-it-yourself cost.
That's what our engineer will do. He will be in person on the phone. It's an actual human doing this. And so situations like that, we can't save everything. We're going to do our best, and I think we're actually going to have our engineer redo that cost seg, get similar results, and present that to the IRS. We'll see if that works. But what a cost segregation is, let's set the stage there. Because a cost segregation is what gets that magical bonus depreciation. And all a cost seg is, from a very high level, you buy a rental property, it's when you go to close on that rental property and you hand that closing statement to your CPA, it's just going to say, hey, I bought 123 Main Street for $700,000. They're going to stick that $700,000 between land and building on your depreciation schedule and just depreciate it over its useful life, which short-term real estate is 39 years. So they're going to take, let's say that building is $600,000, the land is $100,000. They're going to take $600,000 divided by 39. That's your depreciation. What the accountant is missing is when you bought 123 Main Street for $700,000, you actually bought countertops, you bought flooring, you bought an oven. I bet there's bathrooms. Hopefully you have a toilet and some showers. You have sinks, you have HVAC.
You have a driveway, you have plumbing, you have decking, you have pools, you have landscaping, all those things. And get this, even though this has been done for 50 years or more, the IRS says if you're depreciating all of that over 27 and a half or 39 years, that one big cost, you're actually breaking the rules. The IRS says that driveway has a 15-year useful life. The flooring has a 7-year useful life. And you're supposed to depreciate it over that period. And you're actually using an impermissible method for depreciation if you're depreciating it over the 39 years. Just so happens the IRS doesn't care if you claim less of an expense that you're entitled to. They only care if you claim more. But
so that's exactly what a cost, think about the term, cost segregation. Segregating the cost of that rental property, and our engineer or an engineer you find, don't DIY this thing, an engineer is going to put a value on that driveway, put a value on that oven, put a value on the flooring. And then instead of buying 123 Main Street for $700,000, you have bought a driveway for $30,000 and appliances for $8,000. All of that's not 39-year property. That's 5, 7, or 15-year property. And the kicker in this is if 39-year or 27-year property is not eligible for bonus depreciation, you cannot write off, and we have 100% bonus. So that means you cannot take 100% deduction on the building. But if you segregate the costs into 5, 7, or 15-year class lives, that is called qualified improvement property, which was put in 2017 under the
or
TCGA.
the 15-year is the qualified improvement property.
And then you can write off 100% of those assets allocated to the 5, 7, 15-year class life. So where the big deduction comes in, this $700,000 property, let's say 300,000 of it is segregated into 15 years and under. You write off $300,000 of depreciation in 1 year because it's eligible for bonus. You've created bonus depreciation by just being smart and strategizing.
But as Kevin's mentioned, and I'm just going to add one more time and we'll drop this, use a cost segregation specialist. Don't do a do-it-yourself thing. Don't do that. Some CPAs out there, because we consider doing it. A CPA can go and buy a cost segregation computer program and do the cost segregation study for you, but they're basically doing what you would do on the do-it-yourself. And unless they are like a real estate contracting with an engineering background one, they're not going to do as good of a job, or a job that might even stand up to the IRS. Even if they guarantee audit defense, that just means they're not going to charge you to defend your audit. They can't guarantee the results. They're not allowed to guarantee the results. Use a true, if it's not our engineer, use some other cost seg engineer or specialist, please.
Yeah.
Let's talk about, though, because we're back, this is short-term rentals is our focus here. Short-term rentals are better for a lot of people than long-term rentals or single-family residents. And a long-term rental is considered, generally from the IRS code, any property that has an average lease length of more than 7 days during the tax year, IRS considers long-term unless it's a bed and breakfast. So that makes short-term rentals different. But why does that matter? Can you kind of explain our income buckets to
Yeah,
us?
because if you think about it, I think it was back in the 80s, people were making millions of dollars and just going and buying passive real estate. It was a quote unquote loophole because people were offsetting their earned income with assets that they weren't managing, and they were just scooping up passive real estates, having someone else manage it for them, and they were offsetting their earned income with passive losses. Well, we tied that loophole up with Section 469, passive activity loss limitations, so where now they're in two different buckets. You have an active bucket and a passive bucket now. It's not all just one bucket. So if you are self-employed, if you are a W-2 employee, maybe you're both, and you have an income problem in the active category, you can't just go willy-nilly passively buy real estate, do cost seg, what we talked about, bonus depreciate that, and expect that large loss that you've strategized for to offset your W-2 income. It just won't. So step one in any real estate strategy is first diagnosing where your tax problem is, because let's say you do have a passive income problem. Let's say you own 3 or 4 businesses that you're an equity owner in, but you're not managing the day-to-day. That could be passive activity income coming into you. Then maybe you could passively buy real estate. So you can kind of see how everyone's tax situation is different. That's why specialized tax planning is so key. But step one in any tax plan is always diagnosing where my tax problem is. Then what strategies am I going to utilize to offset my income in that category? And when it comes to real estate, short-term real estate defaults to passive. Whenever you buy any real estate, it defaults to passive. Yep. The burden and the activity that is put on you is to move it from passive to active. And then if that's the case, if you have an active tax problem, how do I get real estate in the active bucket? Well, with short-term real estate and long-term real estate, there's 2 different ways, 2 different tax routes there. Way different tax rule sets. So if you get into short-term real estate moves from passive to active differently than long-term real estate. Long-term real estate's harder to move from passive to active. There's ways, and if we'll get into that next episode of long-term real estate, there's so many cool things you can do with long-term. But that's why you got to meet with a really good tax strategist, because we need to show you how to move short-term real estate from passive to active, because it's easier than you think, but it's more complex in the details.
Because there's a lot of potential gotchas in there. There's a lot of hoops and hurdles you got to jump through. Like, you can follow it and qualify as a material participant on your short-term rental, but if you exceed the personal use allowance, boom, you don't get to take a net loss against your active income. There's a bunch of little caveats there that you got to follow. It's safe. This is tried and true and legal if you do it the right way. But you got to do it the right way. And I don't do TikTok much, but we've got people in our office that talk about TikTok, and I've tried to look at it a little bit and listen to some of these tax people. There's so much misinformation out there. There's misinformation on podcasts out there. Do this and you can write it all off. But they don't tell you all the details, or sometimes they even tell you the wrong thing. One thing that kills me, and I've heard this on multiple podcasts, seen on one TikTok, they say if you have a short-term rental, you cannot treat it as an active property or take an active loss from it if you have a full-service management company. That is categorically wrong. If you do have a full service management company, it's harder, but there are ways to achieve it. So just be careful. Make sure you are working with someone who really knows what they're doing, or you go learn the tax law, learn a lot of it, because there's a lot of details in there. There's not just one tax code, not just 10 tax codes. There's tons of things, and then tax court cases that all apply. But if you follow those, you can have the IRS pay your down payment for a short-term rental. Again, that's not always the case, but it can be.
Yeah, and we've seen it be the case. I mean, we're telling you the testimony of our clients on their behalf. And I mentioned in the prior podcast, the entity setup, the creation, buying your real estate. We have that real estate planning package. This is exactly what we go through detail in your specific situation. how do I move my situation? Well, first diagnose your tax situation, but then once we need to move, if you're an active problem, we show you how to move short-term from passive to active. We show you creative expenses as well. You're probably driving out to the property. You're probably flying to the property if it's across the country. You are buying meals. You might have children that are helping you run this, or we can maybe make an argument they are helping you. So your vacations, you can enjoy your property. Go buy that beach house you love in Florida and utilize it when you're not there. Utilize it for a business purpose.
Income generation.
Income generating when you're not there, but
Let your
then
tenants pay the note for you.
and then go visit the beach as your family vacation. Now there needs to be a profit or some sort of management reasoning that we're flying to Florida. There's some reason
Yeah,
we're
you gotta
going
be
to
very
check on the
careful here.
property, and we need to make sure we're doing legit work and keeping track, and we'll teach you how to log it and do everything else to make sure you're
There's
safe.
so many technicalities in that you just got to be careful and make sure you're working with an expert. But you absolutely, so there's a personal use rule. You can't use your property for more than 14 days or 10% of the days rented, whichever's less. Whichever's more.
Greater.
Whichever's greater. I always get that wrong. For personal use. But if you're there on the property and you and your wife are working building your furniture from IKEA for 10 hours a day for 4 days, that's not personal use. But the burden of proof is on you, the taxpayer, to be able to prove that you did that. And just because you wrote down that you did this or you use some kind of timesheet, time log, that's not always enough to stand up and audit. There's so many technicalities that you need to be aware of. But if you do it, you can do it right. Let me go into this area, just real quick caveat, and we'll get more into the tax stuff on this. Kevin and I preach, don't ever let your tax tail wag your business dog or your investment dog. Yes, the tax benefits are great, but if you go buy a property that cash flows negative, that you're having to use your hard-earned job money to pay down the debt and pay the operating expenses each and every month, yeah, you got a tax benefit, but that's not a good investment. And again, it used to be, until the vacation rental world blew up and Airbnb and Vervo got as big as they are, there used to be, it was a lot easier to make money. But now with interest rates as high as they are, property values as high as they are, as much competition as there are in the short-term rental market as there is, you gotta know what you're doing. We know how to save the tax, but we also work with a company called Vodacy. The clients that we work with that utilize Vodacy and learn from Vodacy, Sean Moore is the coach, and he's run on short-term rentals for many years, and he's learned how to do it successfully. They make money with them. The ones that do it and follow the advice. Not every single one of them, but a much higher majority of them than the general public. Learn about it. You can go check out the Vacation Rental Revolution, that's Sean's podcast. If you're interested in, listen to his podcast and see if this is something you want to do, because it does take work. You can't expect to do this passively. You have to be active. You got to qualify for material participation, and you better make money with it or you're not going to be able to do this each and every year. But here's some of the success stories I love where people have done it. They make money. They are utilizing the tax benefits. And all they had to do that first year is come up with that first down payment. And you can do this sometimes with 10% down. 10% down. They came up with that first 10%. They employed all the strategies that we taught them, that Vodacy taught them, or they were really good and self-taught and made money, and they bought another one in year 2 with that same down payment because they got it back from the IRS. And then in year 3, they bought a third one. And in 5 years, they have 5, 6, 7 of these properties. And suddenly, the income coming in from their vacation rental business is more than their salary was. Now they don't have to work. They might still choose to work, or in a lot of cases, they work less and just do what they want to do, or they turn away clients or get a better job that pays less. You can do this and utilize the tax code to leverage building your financial freedom.
Yeah, and I like how you mentioned Vodacy. Sean did not tell us to plug them. He doesn't pay us to plug them.
Nope.
You don't have to pay me to plug this. I can see the fruit in his group. It is a group of people. They're going to have lenders in there where the CPA's in it. Engineers are in there. You got interior designers in there.
Which is a big deal.
It's a huge deal. And so if you've never done the short-term rental investment, check Sean out. It's Vodyssey. It's Odyssey with a V at the beginning when you spell it.
VODYSSEY.com.
Yes, and one of the big parts of this is they actually do because they do the actual analytics. It's
Yeah,
called Air DNA, to where there's like, hey, do you want a beach
they
house? Do you want a
underwrite for
cabin?
you.
Do
They
you
do
want
the
a
underwriting.
yeah? Do you want a mountain house? Do you want something suburban, urban? Here's where the market's hot. Here's where it's not. They have pre-vetted properties. Hey, we already vetted these properties, these are going to cash flow, because if you get down to it, you need to cash flow. And more often than not, our Vodyssey clients are cash flowing, and we're taking care of the taxes. And going back to our prior episode, please go listen to that, because if you want 7 to 10 rental properties, just be careful of over leveraging that and finding yourself waking up 10 years from now and you're $5 million in debt. That could be weighty.
Or be careful of having a lawsuit. You get 7 built up and then suddenly something stupid happens on one of your properties and you lose them all in a lawsuit. Be careful. There's a lot that goes
Yep.
into this. I guess
Exiting too.
exiting.
Because we need to talk about a little bit in exiting in a future episode, just because there's so much here. So this is a two-edged sword. Well, everything we're talking about here, we're preaching the greatness of it because we see it impacting people's lives. So I'm excited to tell people, hey, there's ways to save taxes with real estate. But there's always a flip of the coin with the Treasury Department and the IRC, the Internal Revenue Code. It's never a free lunch. If they're going to give you a big deduction on the front end, they're going to say, hey, okay, you legally did that. That's cool. But it's not free. There's going to be a moment when you pay that back. That's called depreciation recapture. There's ways to mitigate it. There's ways to defer it. And we're going to get that into a future episode, but it's
There's
not
even
a free
ways to
lunch.
avoid it, but you got to be careful. You got to plan. You got to know the strategies. Let's just go on a little more basis, because you mentioned depreciation recapture, and I see even with CPAs in our firm, when that term comes up, they get like, "Oh, this is big, complicated." I want to kind of simplify it a little bit. I'm going to oversimplify this example. Let's say you go buy whatever $500,000 property, and you do all the rules, and you get to deduct $100,000 that first year against your W-2, and it saves you $37,000 in tax. If you turn around and sell that property in year 2, the IRS says, "Wait a second, we thought you were going to operate this forever, so and we have this rule set under depreciation recapture. It says if you're going to gain that benefit of $100,000 deduction and you turn around and sell that property next year, we want our money back. We want that benefit back." Normally, if you don't depreciate an asset, you turn around and sell it. If you have any gain, you pay capital gains tax. If you've held it for over a year, you pay long-term capital gains tax. What depreciation recapture says is, hey, the benefit you got prior, instead of paying a capital gains tax if you have a gain, you are going to pay ordinary tax up to that amount of depreciation. Don't get stuck and don't get surprised by depreciation recapture. As Kevin was mentioning, there are ways to plan for it. There are ways to mitigate it. Sometimes there's ways to avoid it. But you can't do it if you do it after the fact. Make sure you're doing this with a tax strategist ahead of time before you sell it. Make sure you know when you're buying the property and you're taking these tax advantages, know what to look out for in case someone gives you an offer you can't refuse. Don't get killed with depreciation recapture. And again, I'm going to plug our tax strategy on real estate. We offer an incredible tax strategy package. It covers that. It covers how to qualify as a material participant. It covers the entity creation. It will educate you. It doesn't do any of the work for you, but it will teach you what you need to do to qualify for these benefits, to maximize these tax benefits, and to maximize future mitigation opportunities when you sell. Because generally when you sell something and you made a lot of money on it, you're going to pay some taxes, but you shouldn't pay more, 1 penny more than you're legally obligated to pay. If you do, it's because you didn't know the benefits that exist in the tax code, and that's on your tax strategist's shoulders, or your shoulders if you're not talking to one.
And with our tax package, it comes with that education. It also comes with our team support. And we even have an add-on to where if you want Mike and I to be your personal CPA, we only have a limited number of seats. Mike and I, we are in our clients' plans, but generally we can't service our whole client base. So we take a limited number of personal clients a year. And if you want us to deliver and be your real estate CPA, we would absolutely love to. We have a limited number of seats, but we're going to be there for you with not only the education on the front, but the support. If you have some questions on that tax plan, hey, I've targeted these 2 3-year properties, and again, tell me about material participation. Does this qualify? You know, we are not just going to educate you and leave you high to dry. We are there for your support, and it's all included in one fee. And and the value there is so tremendous. It is if we can save 70, 100,000, depending on your tax bracket, 300,000 in tax, depending on what you're buying. It is a multiple, a
A
strong
30,
multiple. It's a
40x multiple.
no-brainer.
Yeah, it's
And just don't shortcut. We specialize, we live and breathe real estate taxation. We have an engineer, everything's done in-house for one fee. We can get you taken care of. And there's just, like we mentioned so many times, there's so many loopholes, not loopholes, but bear traps that you can step in along this way. So we will walk you through the creation, the structuring, the defense, everything from A to Z in one place, and then we have your support for you the rest of the year. So, yes.
And whether or not you use us, please think differently about the tax code. I cannot stand it that our society has come, in America, has come to see the tax code as this noose around our neck and this just necessary evil. That is not what it is. The tax code is your yellow brick road to growing your financial freedom. There are incentives built all inside of it for good reasons. Depreciation on real estate is there to incentivize the creation of more affordable housing. Oil and gas, the benefit in there, the incentive in there is so that we can be more secure as a nation by being energy independent. There's so many of those incentives in there. Utilize them. Don't fear the tax code. Embrace the tax code. Love the tax code. Leverage the tax code. And if you can't do that, find someone that will be your strategist and your advocate. And we do that at Revo Taxpayer Advocacy.